Hi, Clint Kuhns here, and in this video, I'm going to share with you my ultimate leasing strategy for your rental real estate. So with that, let's get started. Okay, so when it comes to leasing out your property, you're probably doing the thing that many people do, and that is you enter into a contract with your tenant to lease the property for a year or 2 years or however long you can get them to stay in that house. Well, that works. So most people do this, right? We set up our LLC and we put a property inside of it like this, and then we lease it out to our tenants that are going to rent the property from us. Perfect. I get it. It works. So these tenants then, if you have multiple LLCs that you created, many times I see individuals where they have tenants paying each of the limited liability companies rent on a monthly basis. And so you got multiple bank accounts going on, all the money's coming in, you're balancing out the books like you should. Well, that's fine, but I think there's a better way of doing it that I like to do, and that it's going to give you some tax benefits by setting it up this way. It's going to give you greater control over your income, and it's going to change the relationship between you and your tenants. So rather than having the tenants deal directly with these individual entities, what you may consider doing is setting up, I'm going to use a different color here, set up a C corporation. Nope, that doesn't work. Let's set up a C corporation up top here. Set up a C corp. Now, with your LLCs that own the properties like this, enter in to a master lease arrangement between the corporation and the various LLCs that you own. Now, if you haven't used that term before, basically what we're going to do is we're going to have your LLC agree to lease the property to the corporation. So it's leasing the property to the company. So the company's entered into a lease agreement. Now remember, you're on both sides of these transactions here, so don't sweat it. Don't think, hey, if I don't pay myself, I'm going to sue myself. No, we know that's not going to happen. If you want, well, heck, if you want to, call us. We'll help you out there. So the point is that you're going to lease the property from the LLC. So you have this lease agreement. So let's say we put the lease agreement in place where I'm leasing this property from this LLC at $700 a month. From this one at $600, and this one's at $1,000. Now, your corporation is going to turn around and sublease this property back out. So for each of these tenants, this is tenant number 1 for LLC number 1, tenant number 2, right here, tenant number 3. I'm going to have my corporation enter into separate lease agreements with these tenants to live in these properties right here. So the tenants now are dealing with the company itself. They're not actually dealing with the property holding entity. So my corporation, let's say on property number 1 right here that I have this sublease agreement, this master lease agreement for $700. Let's say I'm renting it out to this tenant for $1,000 a month. Great. So I'm renting it for $700. So what happens is my corporation earns $300 here. That is the difference between what the tenant's paying and what I have to pay back to my LLC. You might be wondering, why would you want to do that? Why would I want to have an extra $300 rolling into a corporation? Well, to put it simply, tax breaks. Okay, by having that money roll into the corporation, you then have the ability to start picking up on tax deductions that you may not be capitalizing on right now with your current investing structure. We see a lot of individual real estate investors who come to us and they have this number one complaint: how do I reduce my taxes? Now, if you watch my other videos, you'll know that in certain situations, reducing your taxes is not a great idea if you're looking to qualify for larger loans that are income-based. But if that is not one of your motivations, then yeah, definitely tax planning should be on the radar screen. That's all part of real estate investing: asset protection, tax planning, and business planning. So my partner, Toby Mathis, does a phenomenal job on discussing the various tax benefits that come from investing or having money flow into a corporation. But I'm going to hit on just one topic here. You get the $300 that comes in. So what could I do with that? Well, basically you should expense it out. You could expense it out with medical. Say you had medical expenses. You could pay it out that way, out of your corporation, tax-free to yourself. Vehicle, right? So we could have a vehicle expense we could be picking up through that corporation. You have entertainment expenses, or meals actually, is what we could be running through there. So you have ways to deduct these expenses from the income you're earning at the corporation level. Now, let's say that you don't pull the money out or you don't expense it all out. Well, what's wrong with that? Because at the corporation, it pays taxes at a flat 21%. If you live in California, I can imagine right now you're sitting back thinking, wow, I pay taxes at combined state and federal of 39% or 45%. Well, you just cut your tax rate in half. So any money that you keep inside of that company, let's say I got 300 here off of this lease here, I'm renting this one out for 900, so there's another 300 there, and this one over here is $1,500 a month, so there's another 500 there. What you have here is $1,100 a month. You multiply that out over a year, that's over $12,000 a year. What could you do with an additional $12,000 in your pocket? Either you're pulling it out tax-free, or it's only going to be taxed at 21%. Maybe it's to send your kids to school. Maybe it's to get another vehicle. Maybe it's to fund a retirement account. The point is, now you have options because now the money's coming in, it's being taxed at the lower rate, and more importantly, you have control of it. Whereas in the previous structure where your tenants are paying the LLCs and it's flowing right down to you, you have no control over that income. It's going to be taxed to you at the end of the year in your individual tax bracket. So using a corporation adds a different element to your investing structure. I like this because it gives me the control putting together these master lease agreements. Also, I think it provides an additional layer of asset protection. If you have any problems with tenants, they want to bring any claims against you, those claims are not going against the property owners, they're going against the property manager. Let's say it's a shakedown discrimination type claim that they want to assert because you evicted somebody or you wouldn't rent to someone. Those are common occurrences. Or somebody slips on the sidewalk that wasn't salted properly. Boom, let the corporation pick that up. The corporation doesn't have a lot of assets, so there's not a lot to lose there. We want to keep our assets protected down here and away from our tenants' reach.